The threat of tariffs may have been averted for now, but it's clear we've entered a new era when it comes to global trade, especially as U.S. President Donald Trump takes aim at other potential trading partners. We're lucky to have two very smart individuals to help us navigate through all of this. David Sykes, Chief Investment Officer at TD Asset Management, joins me in studio, and Kevin Hebner, Global Investment Strategist with TD Epic, joins us from New York. It is lovely to have you both here. David, I'm going to start with you. As you try and navigate the endless streams of executive orders and news and things, how do you forecast where you think the base case is for the markets and equities, currencies, everything?
Yeah, so look, forecasting is always difficult, but I think it's fair to say if the facts change, your forecast should change. I would say earlier this week, it looked like there was a 25% tariff on goods from Canada into the United States and from Mexico, and now we find out there's a 30-day reprieve. But I think it's fair to say overall, if tariffs are the tool that are going to be used, hopefully they're not, but I think it's fair to say there's a decent chance they will be. If that's the tool, we probably have to be very honest and say, look, economic growth in this country isn't going to be, as strong as we thought. It all depends on the duration of the tariffs and the magnitude. I think that's a certainty. I think, growth is lower, probably means inflation's a snick higher in Canada, probably means more aggressive actions from the central bank in Canada. We'll see what comes out of Ottawa and their response to this. But, it's unsettling news, I think, and it adds a lot of uncertainty. And clearly for Mexico, similar type of issues. But I think it's also very fair to say that this will have nothing like the impact on the United States that would have on Canada and Mexico. So from a U.S. standpoint, perhaps a bit slower growth, a little bit higher inflation, but I think really the impacts are really going to be felt with Canada and Mexico.
Kevin, I want to bring you into the conversation, and I know that we've been talking to you earlier, and I understand that you believe that the trade disputes and potential tariffs with Canada and Mexico aren't really about them as much as this is about China. And maybe you could just tell me if that's true and why you think that.
There are real issues that Trump has with both Canada and Mexico, but 80% of the tariff wars that have just started, and it is just the starting gun, and this is going to be a marathon, it's not a sprint. We're going to be talking about this for a long time. 80% of the issues have to deal with China. Trump wants to create a new global economic order. He's very, very unhappy with the current situation, the access other countries have to the U.S. consumer, access they have to the U.S. defense umbrella, without, in his view, paying anything for that. And so he wants to reinvent, create a new economic order. And the focus of what he's trying to do is on China, because China is the geopolitical rival. In China, with its $1 trillion surplus, that's a $1 trillion trade surplus. It's enormous, has really wreaked havoc on the global trading system, the post-World War II trading system. It's hollowed out the manufacturing sector in the United States. It's driven enormous imbalances in the U.S. And a very overvalued U.S. dollar. So Trump and his cabinet, his chief economic policy advisors, are very unhappy about the current situation. And so we've just started to create this new global economic order.
I want to bring up the chart that you provided to us, Kevin, which shows the surplus and I think probably the focus maybe of what you're speaking about. So maybe tell us a bit about just what we're seeing there and why it's so important.
So the first China shock, that happened from 2007. And so this is when China joined the WTO. They accelerated their exports and initially hollowed out the U.S. manufacturing sector, costing somewhere between 500,000 and 2.5 million manufacturing jobs in the United States, and decimating entire sectors, for example, the furniture manufacturing sector. So this is very difficult, resulted in much lower labor share of output, resulted in the rise of populism and the disaffection by a lot of Americans with trade. On net, Americans think they lose from trade, and also a real change in how Americans view China. Used to be very positive. Now, a large majority of Americans have a negative view of the Chinese government. And though currently now we're going through the second China shock, and so China is accelerating their export engine again. And so this is again wreaking havoc. The German auto sector is one place where we're seeing that now, but it's also happening in a lot of EMs where China is exporting to. And Trump is determined to stop this process, bring manufacturing jobs back to the United States, create onshoring, and also rebalance the not just the U.S. economy but the global economy in light of this massive export surge from China.
The one thing, David, just bring it back to you for a second, like as you know, I talked about the endless executive orders, and if, you know, as Kevin's highlighting here, what the real focus is, there's just so much change happening and so much volatility. That's the one thing I'd say that, you know, your forecast change depending on the information you have. People need to buckle up because I'm assuming there's going to be a lot of volatility coming.
Yeah, look, I think our firm outlook is that expect the unexpected. You know, we're going to have to see how this goes. But I don't think you throw the baby out with the bathwater. I don't think you abandon the old principles and discipline that investors should always have. I mean, you know, we've seen volatile markets this week, but if you'd owned government bonds or had a smattering of government bonds in your portfolio, you've actually done quite well. Mm-hmm. And, you know, even though there was this news that 25% tariffs were coming, well, lo and behold, you know, in a few hours after the market opens, oh, they're delayed a month. And so the markets have done quite well since. And so I still think it pays to understand the basic principles of diversification, asset class diversification, quality, you know, real companies with real earnings and real cash flows. I think that is something that you really have to pay attention to. And yeah, maybe you want to lighten up and have a little bit of cash, you know, for some optionality. But I think we have to go through this with the wisdom that there's a lot of talk, but we need to understand what the facts are. And right now, the facts are few and far between.
Let me ask Kevin again, because you watch this closely, and on the facts. I mean, there's what we know today, and I'm going to apologize. I'm going to ask you a really hard question and give you like a minute to answer, which is not fair. But when you think about the trajectory we're moving towards, and with what you know today, what do you think the end game is? Where do you think this is going to all net out?
So the end game is this new global economic order. And I think Trump and his advisors at Treasury, Commerce, and the USTR have some idea of where they want this going. And aside from China, you have a number of other countries that are manufacturing powers, big current account surpluses, undervalued currencies. So for example, Germany in autos, but also in Northeast Asia, you have Japan, Korea, and Taiwan. These are other countries which would be targeted by the Trump administration. So I think it's going to take really through 2028 for this to play out. And as David says, there's a lot of uncertainty about the pattern, but it is important to keep in mind what is important to Trump. And Trump wants to bring manufacturing jobs back home. He wants to have fewer imbalances in the global economy. And he also wants a higher S&P. I think his tier one priorities are very clear. And that's important in spite of all the tweets we get from him and sort of the massive zigs and zags we get in market, to focus on this trend and where we're going over the next 3 to 4 years.
Kevin, we've been very focused on tariffs, but there's only one part of the platform that President Trump and his administration have been talking about. You know, we're expecting a lot of deregulation. We're expecting a lot of, you know, potential tax cuts. How does that all factor in?
Yeah, I think it's important to put tariffs in the context of overall what Trump and the economic team are trying to do. So tariffs do a number of things. It encourages home shoring, hopefully it reduces imbalances, but also creates revenues. And for example, if you had the 25% tariff on Canada, Mexico, and then the 10 on China, that's about $120 billion a year into the coffers in DC. And that would go a long way to doing two things. One is paying for a corporate tax cut from 21% to 15% for companies who are producing in the United States. It would also go a long way to compensating American companies and individuals who lose from the tariff war. In 2018, Trump spent $28 billion to compensate U.S. farmers, particularly soybean farmers. And so this would be part of that. Now, in addition to tariffs, there's going to be a lot of focus on deregulation. And so not just within DOGE, but beyond that, a very pro-tech bias within the administration. That will include AI, crypto, but a host of tech areas, including defense tech. And then thirdly, the corporate tax cuts. So broadly, it is a pro-growth economic program. Maybe tariffs will reduce U.S. growth, say, by 40 to 50 basis points and increase the price level by 20 to 30 basis points. But overall, it's pro-growth. Tax cuts are very good for earnings. Deregulation is very good for earnings. So overall, it should, and there will be a lot of choppiness in markets. So I wouldn't want to underestimate that. But it should be a constructive environment for equities. The other asset class in this is US dollar, which is currently massively overvalued. It's likely to get even more expensive with US tariffs because the dollar will accommodate about 30%. But at some point, there will be a reckoning there.
Yeah, and that's one to watch. I have to ask, though, like, I guess what could break? I mean, I think, when I think about what they're doing, I think people would look to say, maybe the US dollar, they're weaponizing that a bit, the US consumer, they're weaponizing that, and they're changing everything all at once.
Yeah, look, you're exactly right. I think the real fear in my mind is it's just an escalation. They put a tariff, we put a tariff, they put a tariff, and go around the globe and do that. But I think Kevin's central point is really crucial. At the end of the day, it's a pro-growth strategy with President Trump and his administration. And if you think about where we are right now in earnings season, very, very strong earnings season come out of Q4. And I think there are definitely things to remember about future tax cuts, dereg, from a business standpoint that are very, very positive for equities and for earnings. And in terms of Canada, though, there are two unintended consequences, which I personally find fascinating. The first is, we need investment in Canada. I think that's a fact that we can all agree on. And this is probably going to pause investment in CapEx and business investment, which is not necessarily a great thing. But the other unintended consequence, Canadians are now talking about the economy. We're talking about our exports. We're talking about Buy Canada. We're talking about productivity. And that's interesting. We're starting to talk about the things we have in this country, whether it's oil and gas and rare earth metals and what can we do. And I think that's an interesting unintended consequence that's been missing from the conversation. And frankly, from a business standpoint, from an earnings standpoint, I think that's very positive.
Kevin, I'm going to give you the last word. I've only got about a minute, but I want to stick with the theme of unintended consequences. Are there other things you're thinking about or watching that just you're going to have your eye on?
So on David's point, I think this pivot, and certainly in the United States with the election of Trump, there is this pivot to it's time to build. It's time for growth. It's time to get the government out of the way of companies in the tech sector, in other sectors. So I think that is important. And I suspect that there will be a similar vibe shift in Canada as well, with a bit less focus on regulation and distribution and a bit more focus on the need to build a more sensible tax structure. And ultimately, that should be constructive for growth and for equity markets.
Let me just squeeze one last thing in, and I guess I'll come back to you, David. Is it going to stick? I mean, there's governments that have mandates and their time, then things can revert back. It's interesting. Do you think these things will stick in the longer term?
Well, we'll have to see. I mean, again, that's why you come back to the only free lunch in my mind in capital markets is a diversified portfolio. Yeah. So it's time to institute that if you haven't, and I think for those who have, you're going to get through the next 4 years, you're going to get through the next 8, 12 years. Just don't focus so much on every single headline that's going to come up. It's going to be busy. There's going to be a lot of news and a lot of noise. But I think people just need to have a cool head in this. And let's look at the facts. And let's make sure we focus on diversification and quality. That will see you through this.